Welcome to Alpha Insights. I'm Lane. Today we're digging into a seasonal market quirk that hits the cannabis sector every spring, the so-called Ides of March effect, and why it matters for traders and investors. Joining me is Josh, market historian and guide to trading cycles. Josh, great to have you back. Remember, if you have questions as we go, you can ask us at stockalpha.ai.
Thanks, Lane. Glad to be here. Markets are open today, so this is a timely conversation.
So let's start simple. What do we mean when people talk about the Ides of March in cannabis trading?
It isn't mystical. It's shorthand for a predictable drop in liquidity that tends to show up around mid-March and then stretches into spring. Trading volume falls, spreads widen, and the market gets jumpy. So news moves prices a lot more than usual.
How big is that drop typically?
Studies and flow patterns suggest average daily volume can fall by around 20 to 40% compared with the monthly norm. That's material. It makes executions harder, especially for larger orders.
So lower volume equals bigger price reactions.
Exactly. When liquidity is thin, a single headline, an earnings surprise, a state ballot development, a regulatory comment, can push a stock 5 to 15% in a day. That applies to single companies and to the sector ETFs as well. I mean, when you look at the data, thin markets amplify everything. Market makers widen quotes to protect themselves, retail traders see more slippage, and institutions hit capacity limits for short-term trades.
Short reactions, right.
The other dynamic is concentrated ownership. Many cannabis names have a handful of big holders and episodic retail interest, so a few large trades can move prices a lot more than they would in a broad, liquid stock.
Which names are most exposed here?
Larger, more liquid companies like Curaleaf, Trulieve, Tilray, and Green Thumb still feel it, but smaller operators are the ones that really suffer. And the cannabis-focused ETFs, the pure cannabis funds, can swing more than you'd expect when flows concentrate in a low-volume window.
Interesting.
So the real question here is, what should traders and investors actually do about it?
Yeah, that's a good point.
First, think position sizing over timing. Reduce trade size relative to typical capacity, especially in small cap names. Use limit orders so you control execution price. Accept the chance your order doesn't fill rather than taking big slippage.
What about using ETFs or options for exposure?
ETFs can be useful for a basket level read, but they're not immune. When underlying stocks are thin, the ETF can move more than normal. Options offer defined risk. That's attractive. But option markets can also be sparse, with wide premiums. Check option liquidity and implied volatility before you trade. Monitor catalysts closely. The main triggers are earnings calendars, state ballot deadlines, and anything from Congress or regulators about federal policy. Those are the moments that will interact with the thin market and create outsized moves.
And what about the more strategic view? Is this an opportunity or a risk?
Both. Optimists see mispricings. Disciplined buyers can accumulate quality names at better prices if they size conservatively. Pessimists see execution risk and headline sensitivity turning small drops into large losses. If you're long-term and focused on fundamentals, you can treat the noise as noise, but you still need to be careful with how you trade through this window.
Honestly, I was a bit surprised by this one.
The forward-looking concern is real. If meaningful federal or state actions come later in the year, traders who ignored Ides liquidity issues might be forced to trade at bad prices. Conversely, if nothing material happens and earnings disappoint, the thin spring market can deepen drawdowns.
Quick checklist for listeners.
Sure, size trades conservatively. Use limit orders. Prefer defined risk structures if you need exposure. Monitor catalysts closely and consider ETFs for broad exposure, but be aware they can amplify moves when liquidity is low.
Great. 2 short reactions.
Right.
Interesting.
To wrap up, treat the Ides window as a liquidity event first and a sentiment event second. If you plan and size properly, there are opportunities, but the path will be bumpier than in higher volume months.
Thanks, Josh. That was really useful. Before we go, a couple of quick takeaways for listeners.
Go ahead.
1. Expect lower participation and wider spreads around late February through late June. 2. Trade smaller, use limit orders, and watch catalysts. 3. ETFs and options can help, but check liquidity and implied volatility first.
Good summary. And if anyone wants us to look at specific names or a trade plan through this window, reach out.
If you have questions about anything we discussed today, you can ask us directly at stockalpha.ai. We answer listener questions live. And for more market insights, head over to stockalpha.ai. Thanks for listening, and thanks, Josh.
Thanks, Lane. Talk soon.